Okay, good evening, everyone. You're welcome to our case study class. Please confirm from the chat button if you can hear me so that we can start. Okay, thank you for the confirmation. You're all welcome. Okay, so sorry, because of the network, so I may not be on video, but let me see how the network will look like before I can probably come on video. Okay, so but if you can hear me clearly, I think that's the most important. Okay, so you are welcome, and we are going to start right away. I was trying to wait for some of our people to join before we actually start the lectures this evening. We have started discussion in about 2 or 3 weeks ago and case study. And I want to believe that we are already gathering momentum, into the case scenario. I have some people saying they cannot see me, but if you can hear me, that's fine. I'm trying to manage the fluctuation in the network, so that's why I'm not on video. Okay, maybe I'll just come on video briefly. But if you can hear me clearly, that is what is most important. Okay, all right. So as I was saying, we have started the discussion around case study, and I want to believe you're already gathering some momentum. Your level of confidence is increasing by the day as to case study when it comes to ICANN question as we wait patiently for the pre-scene analysis that will be released that'll be first week in May, thereabouts. So obviously it's going to be 2 weeks to the exams, okay? And we have been able to give you the content of case study, and we are already trying to take a look at those contents. I gave you some explanation on how to go about the content of a good business report. And of course, I also showed you samples on what you're expected to write, under those content. So we can remember, we started off by saying that if you have a case study scenario, the very first task is to determine whether you are writing internal or external reporting. And then I gave you the right questions to ask on how to determine whether you're writing internal report or not, or otherwise. And of course, that will affect the outlook of your cover page and the tone of your reports. And we also went ahead to check how your cover page would look like if you're writing internal reports, and of course, how it will look like if you're also writing external reports. Okay, then from there, I made mention to say that the next thing is your executive summary. Obviously, your executive summary will be at the beginning of your report. It is placed at the beginning of the report, but it is written last because your executive summary will demonstrate it's a condensed version of your entire report. So it's a way of summarizing the entire content of your report in such a manner that the reader will understand the entire report without having to go into those reports. So, and I also mentioned that I'll come back to take you executive summary, but that'll be a class on its own. So we needed to understand, the content of your main body of your report. So before we can even know what to summarize in the first place. So from there, we went to introduction, which I mentioned to say it will be on page 5 or page 6 of your answer script, depending on the number of pages you have left for executive summary. But remember, I said the executive summary ideally should not be more than 3 pages. But I also advised how you can leave about 4 pages, not sheets. This time around, I mean pages. So what that means is one page, one sheet means 2 pages, okay, front and back, thereabouts, so to speak. Okay, so if your introduction, if you write your cover page on page 1, so that means the next one will be on page 2, 3, and page 4. But we are leaving 4 pages to be on page 5, up to page 5. So that means your introduction will start on page 6. I'm re-emphasizing all of this so that you are highly organized when you get into that exam. So you are not just, thinking on what to do. So that's why I kept emphasizing on this. So under your introduction, I also mentioned to say that you're going to do 2 things under that. The first thing is you are linking your report to the mail that was sent to you by your boss or the mail that was sent to you by your clients in the case of external reports. So the reason here is because you're not the one that wakes up one day and say you wanted to write that report. So obviously something triggered that reporting. So that's why you must make reference to the mail that was sent to you by your boss in the case of internal reports, and the mail sent to you by your client, in the case of external reporting. So that is what is called terms of reference. And after then, you will load that your introduction with the requirements in the case. And I mentioned to say that by the time you do all of that, you might probably be writing about 4 to 5 paragraphs, depending on the content of your of the requirements in the case. I mentioned to say that the first exhibit you are going to see under the unseen when you get into that exam will be where you have your requirements. So most likely next week or 2 weeks time, we'll start checking ICANN case scenario, real life scenario. Okay, so that you can also have a feel of how it looks like. Okay, and I said again, after you might have linked that report with the mail that was sent to you, and you have loaded the requirements in the case scenario, I mentioned to say you should also consider what was it called? Apply professional skepticism. I think I gave you a number of professional skepticism you may apply. We talked about possibility of withheld data. We talked about industry performance average not giving. We also talked about accuracy of sources of data. And of course, if the account or the financial statement you are using is unaudited, you also exercise professional skepticism. How do you compute how do you compose all of that? I've already done that for you. All you need to just do is to learn it properly, and you're able to do that. So all of those professional skepticism obviously will be a paragraph each, and there are some that are general. So regardless of the kind of the case scenario you're writing, they will always feature. I remember telling you to say possibility of withheld data will always be there. Okay. Industry performance average. Most times I've never seen ICANN putting up industry performance average, even though they can do that, but obviously it's something you might also consider because I'm not seeing that in that case scenario. And the possibility of withheld data, as I mentioned, source of data, alternative source of data, all those ones we always, feature as professional skepticism. What you may not feature is unaudited result. What I mentioned to say, the moment you're giving management accounts or you're giving summarized financial statements, then most likely it is unaudited, especially management account. If it is summarized account, you can query to say you are not sure whether the account is audited or not. And sometimes the examiner can be explicit to say it is an unaudited account that you're using. So the reason why you have to exercise professional skepticism over this is because if you use unaudited accounts to analyze the company's performance, obviously it is less reliable because when the account is eventually audited, it might distort the result of your analysis. So that's why it is important to exercise professional skepticism. And after then, we are going to consider wider context. So those are issues in the primary economic environment in which the entity is operating that is probably having negative or positive impact on their performance, but they don't have control over it. So that is why it is called wider context. So I think I gave one examples. If you remember, I talked about EndSARS in Nigeria. So the EndSARS probably is affecting the performance of some companies, but obviously, you don't really have control over it. Okay, but don't forget, it could be positive or negative. Interest rates, exchange rate volatility, those are examples. Neglect by the government in a particular industry is also a wider context. So now, but then you cannot use all those extreme examples. So we have to look at the case scenario and see which issues or what issues do we have in the primary, in the economic environment that's affecting the company's performance. Remember, it can be positive or negative. So when we start seeing case scenario, I will also show you how to determine that in a case scenario. Okay, so that's that under your introduction. So remember, introduction will be a title or subheading or heading really or in your report. But when it comes to professional skepticism or wider context, they will not be under an heading. So they will naturally be embedded in your reporting. But I mentioned to say professional skepticism can feature anywhere in your report. But in my own way, I just advise to say immediately after introduction, in a new paragraph, just start with professional skepticism. So that will give you a lot of balance and of course some confidence, for you to settle down time when you are in the exam hall. So today, okay, so I also said after your introduction, you have business analysis. So business analysis has to do with business model. And I remember telling you reasons why we may not take on business model, because since May 2019, ICANN has not tested business model around PESTEL, Porter's value chain, benchmarking, SWOT analysis, BCG matrix, and all of that, okay? So he has actually stopped testing all that. I guess probably they have left it for corporate strategic management and ethics at skills level. Okay, but again, I remember mentioning to say once the pristine is released, and probably I smell any of this business model, I might likely do it. But I will also put a caveat there to say you have to do that if it forms part of the requirement in the case, or probably the requirement in the case is indicating that you should actually do business model. So I don't want to leave it. I don't want to, put it away just like that, even though he has not tested it since May 2019, and this is 2024 already. Okay, so that's why I will not take on business model for the purpose of this lecture, but let your mind be at rest. If we have the pristine and I see any of those business model and I have strong feelings to, incorporate that in the report, obviously, I'm going to do that. Okay. So after then, we have financial analysis. And that's what we'll be dealing with this evening. Okay. So I have a couple of minutes to bless you, and I needed you to listen. So wherever you are, I just need you to listen. It's just trying to manage the network. So that's why I'm not on video. I really wish I can be on video, but don't worry, you can see me as we move on. So wherever you are, whatever you're doing, I just wanted you to put me on loudspeaker and listen attentively. Don't say I'm going to listen to this video at some point. You may not really have that time, okay? So this time that you have now, I wanted you to listen to me. So before we go into the financial analysis, I think I have something on the screen. So this is just a kind of reminder of what we have done so far, okay? So you have professional skepticism and ethics. Now here, these are some of the things you might consider, when writing your report. For example, identify that information provided in the case may not be accurate. Remember, we talked about that. Then also bullet 2, they're saying identify other possible sources of getting more information. I think I also mentioned that. Identify that the fact that unaudited financial statements are less reliable if presented in the case. We also discussed that. Identify unresolved issues with external auditor. These are ethical issues. So in some cases, you might see where the management refused, to comply with an advice coming from the external auditor, probably to recognize certain items or to make adjustments, to certain items in the account. So management refusal to do that, or frequently changing external auditor can be an indication around ethical issues. So you might need to also consider that if that is, presented in the case scenario. But of course, identifying the possibility of withheld or incomplete information, we also discussed that. Consider tax implications, if any. Then also identify if industry comparative data is not provided and make a comment. I said that already. So this is important because the fact that the company's revenue is increasing may not necessarily mean they are doing well in that industry. Okay. And how do we know they're actually doing well? I need comparative data. And if the revenue is declining, or probably their performance is declining, I also need something to compare with within the industry. How do I know? I need comparative information. So if not given, then how will I know whether the company's good performance were due to general industry performance trend or as a result of operational efficiency? So we don't know all of that. So that's why you need to, carry out you need to carry out or exercise professional skepticism. Then again, if market share was not provided, you also identify that and comment. If market size is not provided, you also identify that and comment. And most of these things, you don't see it in ICANN case, okay? So these are, easy way of, writing a great report already. Then, and of course, for your data and information, you have use the business financial statements that will be provided. For example, statement of profit or loss, and a statement of financial position, note to the accounts, the email that was sent to you, and of course, identify wider context of the company. Okay, so in terms of analytical skills, you need to look at revenue trends and changes. Those are discussions. So this forms part of your financial analysis. And of course, this will be your requirement one, okay? Look at increases in payables and receivables, including inventory. You have to discuss. Look at profit after tax. Is it dropping or is it increasing? Analyze possible sources of finance, depending on the case scenario. So these are just general points, that you might need to consider. Okay, comment on profit, that's gross or net profit. Also comment on inventory decrease or increase in absolute and percentage terms. Be with me here. Be with me here. What does it mean? When you say absolute terms or relative terms, relative is percentage, okay? And absolute is a raw figure. So be with me. So normally, when I'm carrying out financial, I'm not into financial analysis yet. I'm just giving you some appetizers, okay? But I need you to listen. So no matter what you are doing, anytime I say be with me or listen to me, please, you just have to pay attention. Now, what do we mean by absolute terms or relative terms? When you are doing financial analysis, you can analyze using both absolute terms and relative terms. What does that mean? You can say revenue increased from 200 million to 300 million between year 1 and year 2. So saying 200 million to 300 million, that's what we mean by absolute terms. That is absolute figure. If you don't want to use the absolute figure, you can use the relative terms, which is also the percentages. So instead of saying 200, it increased from 200 million to 300 million. You can say it increased by 50% between year 1 and year 2. That is the meaning of relative terms. So sometimes when you see some reports, you see something like revenue increased between 200, from 200 million to 300 million, or by 50% between year 1 and year 2. So that is acceptable, okay? But for the purpose of your exams, be with me here. For the purpose of your exams, I will advise strongly, don't use absolute terms, okay? Don't use absolute terms. Always use relative terms. And there are two reasons for that. Number one, it's going to waste your time when you are trying to copy those figures. That means anytime you are doing your analysis and you wanted to explain the increases in revenue or decline in cost of sales or gross profit, you are always looking at the question, trying to quote those figures. So it's going to even distort your thinking and process flow. Okay, so it's going to waste a lot of your time. So that's why I want to advise you don't use it. It is acceptable, don't get me wrong. You can do that in practice. But for your exams, don't use abs. In fact, when I write those reports, you will never see absolute figures there. It is okay, in real life. But for your exam, I will advise strongly, except you are very fast. Even if you are very fast, in trying to copy those figures, instead of you copying the figures for revenue, you can mistakenly copy the figures for cost of sales. And it's going to distort a lot of things you are doing because of exam pressure. So that's why I will advise to say, if you want to explain increases in revenue, in gross profits, in whatever ratio you have computed, use the relative term. That's the percentage term. Remember, you must have done all those calculations in your appendices, okay? So just go and be lifting those percentages. It makes life easier for you. So that's what I want to say. If you need clarification on that, you can drop questions for me on the chat button. Okay, so I'm not into the financial analysis yet, but I just saw that and I said, let me quickly pick that up with you. So please take notes. Don't use absolute terms to interpret, okay? Use relative terms. So those are the percentages. So take note of that, okay? Now, under issues and option, you also have some of the comments you can do under that, okay? You have, for example, it's talking about comprising with prior year, industry needs to justify increase or decrease in receivable payable inventory and all of that. So you have so many comments there. Then it also talks about evaluative skills. Here it's talking about maybe you're giving EPS, stock market implication, and all of that. So these are just pointers to some of the things you can discuss. So here, operational and strategic analysis. Where is the business in its life cycle? What generic issues are facing the business? And what are the specific potential strategic issues facing the business? So these are also pointers. So obviously, when we get to the real case life scenario, I'm going to show you how to apply, some of these contents in that regard. So now, sorry. So let's now take a look at financial analysis. So I'm going to do the explanation today, and next week, by God's grace, we'll start looking at questions. Financial analysis. Sorry. Maybe you want to see my face before we start to be sure that I'm the one taking the lectures. So I'm actually the one taking the lectures, okay? All right. Financial analysis. Yes. So, okay. Now, be with me here. This is your requirement 1. So let me say this. Financial analysis is divided into 2. Be with me here. Financial analysis is divided into 2. Number 1, financial statement analysis. Okay. Financial statement analysis. And number 2 is financial data analysis. Okay. Financial statement analysis and financial data analysis. Okay. Now, if you are listening to me, if you can get your pen and a paper, I'll be glad. Okay, for this class. I wanted to use my board marker, but I couldn't find it. I don't even know where I placed it. Okay, so I didn't get it on time. I would have probably, so that I can write for you in the live class, but I may not be able to do that, but just listen to me. I'm going to give you 10 ratios that you have to start learning from this night. Those 10 ratios is what we are going to use to analyze the performance of a company. It can apply to any financial performance analysis, okay? So I'm going to give you, okay? So as I was saying, let me come back to that. Financial analysis. So when you hear the word financial analysis, 2 things comes to your mind. Number 1 is financial statement analysis, and number 2 is financial data analysis. Now, be with me. If you want to carry out financial statement analysis, you need 5 documents. 2 of them are the most important, okay? Let me say that again. If you want to carry out financial statement analysis, I am on financial statement analysis. If you want to carry out financial statement analysis, you need 5 statements. You need 5 documents. 2 of them are the most important. Number 1, you need statement of profit or loss accounts. Number 2, you need statement of financial position. Number 3, you need notes to the accounts. Number 4, you need statement of cash flow or cash flow statement. Then number 5, you need statement of changes in equity. Can I take that again? 5 documents or 5 statements that you require to carry out financial statement analysis. Number 1, statement of profit or loss account and other comprehensive income, otherwise known as the income statement. Number 2, statement of financial position, previously known as the balance sheet. Number 3, notes to the account. And number 4, cash flow statement. Number 5, statement of changes in equity. I have never seen I can bring in all the 5 in a particular case scenario. What they have done the most is to bring maybe 3. Or I think I've seen 3 or 4 of them. Yes, I've seen 4 before. November 2020, it brought in income statement, that statement of profit or loss account. It brought in statement of financial position. It brought in note to the account, and it brought in cash flow statement. So that's the maximum 4 I have seen. But I've also seen, I think, November 2020, no, 2022, it brought statement of profit or loss account, statement of financial position, the statement of changes in equity. Can you see that? So that's 3. So that's what I've seen him bringing. But out of that 5, there is 2 of them that is most important, that must be present if you must carry out financial statement analysis, even at work. You know, it's not limited to ICANN alone. If you are into consulting business and you want to analyze the financial statement, or you want to analyze the financial performance of a company, you needed at least 2 of these statements. And one of them is statement of profit or loss account, another comprehensive income, and of course, statement of financial position. So once I see these 2 statements, I can go ahead and carry out financial statement analysis, okay? So please take note of that. So those are the minimum that you must see. So in ICANN exams as well, you will always see the minimum of those 2. So if he likes, he can add notes to the account, he can bring on statement of changes in equity, he can also bring on a cash flow statement, okay? But the moment you see statement of profit or loss account, another comprehensive income, and statement of financial position, you are good to go, okay? You can carry out great financial statement analysis, okay? Any other financial information, be with me here, any other financial information outside those 5 that I just mentioned that was given by the examiner is known as financial data analysis. Does that make sense to you? For example, if he gives you KPI information, key performance indicators, or he decides to give you budget figures, that is financial data. Any other financial information outside those 5 that I just mentioned, but they have finance figures in it, okay? That is financial data. It can also give you information around NPV. You want you to evaluate a particular business proposal. You want you to do contribution analysis or net present value, payback period, product mix, cost volume profits, okay? All of that are financial data analysis, okay? And that forms your requirement too. Can you see now? We are already dealing with ICANN, or we are dealing with ICANN already, okay? So that forms your requirement too. Go and check it out from May 2019. That's what he has been testing. So requirement 1 is around financial statement analysis, where you are going to look at statement of profit or loss account and the statement of financial position. And requirement 2 is around financial data analysis. And what I've seen ICANN brought over the last 5-6 diets is around NPV and contribution analysis. In fact, NPV dominated, okay, but it's now bringing on, a lot of style of NPVs or a lot of different scenarios under NPV. Okay, please take note of that. Now, this is a new dimension that ICANN is also bringing. So normally, if I want to calculate or if I want to compute or analyze the financial statement analysis, remember I said we needed minimum 2 documents, which is the income statement and the balance sheet. Then again, what analytical tools will I use, okay, to analyze the financial performance of a company? I can use 4 analytical tools. I can use 4 analytical tools. Again, one of the challenges of the examiner is that most candidates, they don't know which of these analytical tools they are supposed to use when analyzing the financial performance of a company. But let me quickly explain them. So the first one is ratio analysis. The second one is trend analysis. The third one is common size analysis. And the fourth one is working capital management. Now, that fourth one, working capital management, also known as cash operating cycle, is already embedded in the ratio analysis, where I like to call it out. So that's why you have it as number 4. So this is what I'm saying. Okay, so this is what I'm saying. This working capital management is already embedded in my ratio analysis. But again, I like to call it out. So that's why you have seen that you have seen it there. They also call it cash operating cycle. Okay, and that talks about your inventory days, your receivable days, and your payable days. Okay, so I'm still coming back to that. Okay, so I'm trying to take it, little by little, so that you can understand. Okay, so I needed any of these 4 analytical tools to analyze the financial performance of a company. So for your exams, am I to use ratios? Am I to use trend? Am I to use common size analysis or working capital? I'm going to explain that shortly. Now listen to me. Instead of the examiner, sometimes, to allow you to use ratio analysis, general ratios. Let me call it general ratios. You know your general ratios, Abi, your profitability ratios, liquidity, short-term solvency, long-term solvency, investors ratios, and all of that. Instead of him asking you to analyze, the financial performance of a company, using those general ratios, he can decide to bring on industry-specific ratios. Industry-specific ratio. What does that mean? Okay, depending on the kind of industry it's bringing, instead of you using all those general ratios, you might have to think about industry-specific ratios. That's what he did in 2020. He brought in hospital case scenario. The company brought in, if I can remember, August Specialist Hospital, yes, August Specialist Hospital. So when they got into the exam, it was not asking them to use industry-specific ratios. So instead of using all our normal ratio that we are used to, the gross profit margin, net profit margin, so it was something else. So it was asking them to start using what's it called now? Some specific ratios that relate to hospital operations. Okay, so you have to be wary of that. So when we see the pricing, we're going to know whether I wanted us to use general, even though we will not say it. Okay, but mere seeing the industry, we might have a pointer. Now let me give you another example. In May 2021, it brought in a retail business. So the moment I saw that case scenario, I know straight up that is going to test industry-specific ratios. Most people were doing the general ratios. So I just went back and started making research about the specific ratios that relate to the industry. And that's what I used to do the pre-scene. Lo and behold, when it got into the exam, it was exactly industry-specific ratio it brought in, okay? So I'm just telling you this so that you can be aware. But obviously, I cannot teach you industry-specific ratios now, because if we want to do that, that means we are going to look at so many industries, and that is going to waste a lot of time. So we're going to learn the normal ratio. If it brings the percent analysis, and the normal ratio we apply, obviously we fly. And if it is going to be industry-specific ratio, I'm going to know, then I'll just try to do some research around that. And that's what I'm going to use to analyze the case scenario, okay? But notwithstanding, we start learning the normal ratio. So that's the first pointer, or that's the first information I needed to pass across. This is the second information. In some of those diets, again, he has also introduced accounting standards. He has introduced accounting standard. He wasn't asking for accounting standard before until I think November 2021. When I saw the case, I know straight up it's going to test IFRS 16 leases because of the preceding case scenario. Okay, so and I have to do leases. That's IFRS 16 when I was conducting the preceding analysis, and when they got into the exam, he asked them question on lease. In fact, the calculation for requirement 2 was on leases. Okay, the calculation was on leases. So thank God I was able to see the insights. That was, I think, November 2021. Then May 2022, thereabout, or May 2021, I can't remember. You also tested, what's it called? Accounting standard, and that was IS2 inventory. Okay, so that was the case of the retail business that I mentioned earlier. It tested IS2. There is not testing, don't get it correctly, it's not testing the standard every diet, but once in a while. So I think he has tested it 4 times. He tested IFRS 16, he tested IS2, I think in November 2022. That was Kudi Microfinance Bank. He tested IFRS 9. Okay, I think that's the 3 times he has tested it. Okay, not 4 times. There are 3 times he has tested it. Okay, so I'm just telling you this. Now the question is, if I passed corporate reporting, do you need to start to go and relearn those standards? The answer is no. You don't need to bother yourself. Once we see the preceding, I'm going to know whether, or I will know the relevant accounting standard that might be applicable, okay? And if I think it's going to be bringing it on, obviously it's going to form part of the report. Okay, so last diet, we're thinking sustainability was a part of the case scenario. So we're thinking it's going to test IFRS S1 and IFRS S2. So I have to prepare candidates around that. But when they go into the exam, he didn't test it, okay? So not all the time he will test all those accounting standards. But I needed to inform you so that you are conversant or you are well prepared ahead of that. But all of these, I'm going to guide you when we have the present case scenario, okay? So please take note of that. Okay, so let me now explain the analytical tools. Remember, we are dealing with requirement 1, which is financial statement analysis. For financial data analysis, there's no way I'm going to teach you because it is a wide world, okay? It is so wide, right? You have NPV, you have contribution analysis. Like I mentioned earlier, it could also slot in accounting standards. You have product mix, everything you do in your PM, variance analysis, some of the things you do in your SFM, okay, can feature there. So it's a very wide aspect. So the only thing is we are going to wait for the present. Okay, so when we have the present, we'll be able to determine or have some insight into what financial data analysis might look like. It could also be budgets. It can give you budget and ask you to analyze, those budget figures. Okay, so we'll be focusing on requirement 1, which is financial statement analysis. So let me start with trend analysis. Trend analysis. Okay, I'm looking at the time, and the time is moving so fast. But at the same time, I don't want to rush it so that you can understand. Okay. So let's look at trend analysis. So sorry, I thought I'll be able to use my board marker to demonstrate all of this, but that's not a problem. What do we mean by trend analysis? Trend analysis is also known as horizontal analysis. Okay, horizontal analysis. So the formula is new year minus old year divided by old year. So if you have your pen, you can write it down. New year minus old year divided by old year multiplied by 100%. Or you can say new year minus base year divided by base year multiplied by 100%. Some people also said it's this old year minus new year divided by old year. It doesn't really matter. So whatever formula you want to use, it is fine. Just make sure that you divide by the old year. Is that okay? Or base year. Base year is also known as old year. Okay. So let's stick to new year minus old year divided by old year multiplied by 100%. So if I'm having, so let me use 2022, 2021, and 2020. Is that okay? 2022, 2021, and 2020. So I want to analyze those 3 years, and I want to use trend analysis, okay? I want to look at revenue trend, for example. So if I'm comparing 2021 and 2020, for example, so 2021 would be the new year, and 2020 would be the old year, okay? So 2021 and 2020. So 2021 will be the new year, and 2021 will be the old year. So the figure for revenue in 2021 will be the new year, whereas the figure for 2020 for revenue will be the old year. That I divide by that 2020 figure, multiply by 100%, then I will get a percentage for my trend. If I'm looking at 2022 and 2021, for example, so in this case, 2022 will now be the new year, whereas 2021 will be the old year. Did you see that? So new year minus old year, or base year, divided by the base year. Okay, so I will use 2022 figure as for revenue for the new year, then 2021 figure for revenue for the old year, then divided by the old year. Okay, so whichever the case may be, make sure you divide by the old year. So if you have learned it previously that it's going to be old year minus new year, it's fine. But let me also mention something. If you are doing new year minus old year, and revenue declined in the new year, so that means the figure for the new year will be lower than the old year figure. So you are going to get negative. Okay, for example, if you make 5 naira in the new year and you made 10 naira in the old year, so that means 5 minus 10 we give you minus 5. Is that okay? So don't bother about the negative sign. So that negative sign is just an indicator that revenue actually declined in that year. Is that okay? So ignore the negative sign, okay? Ignore the negative sign. Somebody said I should come again. Just ask me a specific question because I'm trying to repeat it as many times as I can. So if you listen to me properly, you will grab what I'm saying, okay? But if you are not clear on something, just ask specific question. I'm going to do that again. But let me record that formula: new year minus old year divided by old year multiplied by 100%. But don't bother yourself. We're going to do all of this when we are solving questions. So I'm just still explaining. So they call it trend analysis because you are looking at year in, year out. You are looking at the trend in those figures. By what percentage are they increasing or declining? Now, for your exams, am I to do trend analysis? Be with me here. Okay, be with me here. Am I to do trend analysis? If you have to do, so let me start by saying that whether you are to do trend analysis or not will be dependent on the requirement in the case, okay? Although what I've seen is that ICANN is not also consistent in terms of trend analysis. For example, normally, if you're asked to analyze the financial performance of a company, you are supposed to do trend analysis. But I've also seen in our past exams where trend analysis was ignored. So I'm going to advise to say, do trend analysis, but if you must do trend analysis, only do for the income statement. Let me take that again. If you must do trend analysis, only do for the income statement, provided, listen, provided the items on the income statement are not more than 6. Let me say that again. If you have up to 10 items in the statement of profit or loss account, I am begging you, don't do more than 5 or 6 items. What does that mean? You have revenue, cost of sales, gross profit, other income, admin expenses, selling and distribution, maybe finance costs, income taxes, maybe operating profit, profit before interest and tax, or whatever they call it, EBITDA, or then profit after tax. Okay, when you count all of that, it's running up to 10 or 11 or 12. Don't do all of them. Select the ones you want to do. But obviously, you're going to do for revenue. So you can do for revenue, do for cost of sales, do for gross profit, then go and select another 2 or 3. Maybe one of the expenses that is most significant, then probably your finance costs, your taxes, and your profit for the year. Okay, so that will be the trend you are doing. Don't do more than 5 items. You can select those 5 items, but make sure revenue, cost of sales, and gross profit, they forms part of the items you are doing. Okay, or then some of your cost items, because most likely you might also want to analyze the costs in your reports. So don't do more than 5 or 6. The moment it is up to 10 or 15 items, I am begging you in the name of God, don't do all of them, because if you do it, you are just wasting time. Let me shock you. If you do trend for income statement and balance sheet, you will score 1 mark. So why are you bothering yourself? Okay, why are you bothering yourself? You will score 1 mark. It will only fetch you 1 mark. Meanwhile, you need that information for your report. So that's why it's important for you to do it. So if I'm going to score 1 mark, why am I wasting time? You have written case study before. Go and check. I think I kept mentioning this. You were stuck in the calculation. Case study is not about calculation. Take that to the bank, right? It is about reporting. So that's why we normally say that no matter what happened in that exam, make sure you stick to the plan. And sticking to the plan means you must write that report. They are going to mark your report. Nobody cares about your appendices. But unfortunately, you need that appendices to come and analyze your report. So you have to be smart about it. You have 4 hours. If you have listened to my lectures, a complete module for case study, I'm telling you for free this evening, that 4 hours will look like 40 minutes in that exam. Why? It is not because you don't know what to write. You have abundance of what to write, but there is no time. Okay? There is no time. You have so many things to write, but there is no time. Out of that 4 hours, I can say reading time is 1 hour. Planning and calculation, maybe 1 hour. Then writing a report, maybe 1.5 hours or 2 hours. Okay? But I can't ask you to do that. What are you reading for 1 hour? When you already have the PC, you don't need to read again. When you get in that exam, you have to hit the ground running. Okay, like our president, hit the ground running. So all you need to do is to quickly scan through the unseen. Go and look at the requirements. If it's so close to what you have learned, then so be it. Then you hit the ground running. Okay, so the moment you spend 1 hour under your calculation, which is your appendices, then you have to stop whatever you have done. ICANN is going to overwhelm you with a lot of information. So that's why you needed to plan very well before you get into that exam. It's going to humiliate you. You'll just be seeing oríṣiríṣi information up and down, especially in the unseen. Okay, don't bother. Just stick to that requirement. Just look at that requirement, and you already have your format right from your cover page up to your executive summary, your introduction, and I've already given you the content, or the format on what you're supposed to write. So you just stick to that plan. Okay. So what I'm saying in essence is, if you have to do trend, okay, don't do more than 5 items, but obviously you will do for revenue. The reason why you have to do for revenue is because there is no formula in the under ratio analysis that addresses revenue. Okay, so it's the only trend analysis you will use to analyze revenue growth or decline of that particular company. Please take note of that. Okay, so for your trend, do 5 items. Don't do more than 5 or 6 items so you can select them. Okay, but make sure that revenue, cost of sales, and gross profit are part of the items you have selected. Okay, so start practicing that. So that's going to help you. So let me now go to common size analysis. Common size analysis. Okay, what do we mean by common size analysis? This is otherwise known as vertical analysis. You know, I said trend is also known as horizontal analysis, okay? Horizontal analysis. So common size analysis is also known as vertical analysis. So if you have your pen there and paper, so this is the formula. Item of interest over referenced item, okay? Item of interest over referenced item. Okay, I didn't even put all the formula on this notes, okay? I think it was deliberate anyway. Okay, so that I can force you to listen to me. Okay, so let me take that again. Item of interest over referenced item. So that's the formula for common size. Let me say it again. Item of interest, okay, over referenced item multiplied by 100%. Item of interest over reference item multiplied by 100%. So let me go to the reference item, okay, which is the denominator. So what do you mean by reference item? For your income statement, your reference item is revenue, okay? For the income statement, the reference item is revenue, okay? And for the balance sheet, that's statement of financial position, the reference item is total assets, okay? So the reference item is total asset. So if I want to use vertical analysis, also known as common size analysis, and I'm looking at my income statement, I will now say item of interest over reference item. So remember that my reference item is revenue for my income statement. So I can now choose any item that interests me. So that's why we call it item of interest. It can be cost of sales. It can be gross profit. It can be selling and distribution. It can be admin expenses. It can be finance costs. It can be other income. It can be profit after tax. It can be income tax expense over revenue. Okay, item of interest over revenue. So any of those items over my revenue multiplied by 100%. What is common size looking for? It is looking at the proportion of those items against my revenue. That's what it's doing. So what's the proportion of my costs against my revenue? What's the proportion of my income, of my gross profit in comparison with my revenue? So that's why they call it vertical analysis. So it's just looking at a year in isolation, unlike trend analysis that is looking at year in, year out. Okay, so that's meaning of common size. The same thing with the balance sheet. Any item in the balance sheet over total assets. For example, PPE over total assets, current assets over total assets, or inventory over total assets, current liabilities over total assets. So it's looking at the proportion of those items when you compare them with your total assets. Okay, so that's the meaning of common size, vertical analysis. So the question now is this: am I supposed to do common size analysis in the exam? You know, the answer I will give you is no. You don't need to do it. You know why? Some of the common size formula are already embedded in your ratio analysis. And I can give you 2 or 3 examples. Number 1, gross profit margin. Technically, that's also a common size. You know, in your gross profit margin, what's the formula? Gross profit over revenue. The same thing with, what's it called? Net profit margin. Net profit over revenue. If you now want to bring in certain common size, you can hide them under your ratios. You can just say selling and distribution over revenue. Income taxes over revenue. Is that okay? That is if you are really interested in analyzing those cost elements. But if you are not, the moment you do gross profit, net profit over revenue, you are fine. Okay, so you might not bother about common size analysis because some of them would have been naturally embedded in your ratio analysis. So please take note of that. Okay, take note of that. So let me recap on that. I already said for trend analysis, otherwise known as horizontal analysis, you just do about 5 items and your formula is new year minus ODA over ODA multiplied by 100%. For your common size analysis, you may not bother yourself about that. But again, if you want to do it, it's okay. All you need to just remember is your formula, which is item of interest over reference item multiplied by 100%. And for your income statement, your item of interest is revenue. And for your balance sheet, your item of interest is total assets. Don't even go to balance sheet at all. Don't even try to do it, okay? Because you'll be wasting a whole lot of time. Some of the ratios you are computing, they're already affecting your balance sheet. For example, when you get to liquidity ratios and you're doing your current ratio, it's already talking about current assets over current liability. When you're doing your working capital management, all your inventory receivables and all of that, even your gearing ratio, long-term solvency, they're already dealing with that. So that's why you may not bother with that, okay? So please take note of that. I have successfully explained trend analysis and working capital management. Now, if you have questions, please put it up on the chat. Somebody is saying I should repeat the trend analysis formula. I have said that up to 10 million times, but let me say it again. So what I said was old year, new year minus old year divided by old year. Okay, new year minus old year divided by old year multiplied by 100%. Okay, so what I said, somebody said I should also repeat my last statement. I can't remember my last statement though, but just if you can just ask specific questions, because my last statement is last statement. Okay. Okay, I should repeat working capital. Yeah, I was going to mention that. So for working capital, okay, I mentioned that to say it comprises 3 elements, and that is your inventory days, receivable days, and your payable days. I also said working capital means cash operating cycle, okay? Cash operating cycle. So don't worry yourself. Working capital is already embedded in the ratios that we are going to be computing, okay? So when we get to those ratios, I will explain it further. Okay? So working capital, let me say that again. Inventory days, receivable days, and payable days. Is that okay? But I will explain it when we get into ratio analysis. But as I mentioned, I like to call it that because you have a lot of points to really write around here. So when I get there. So let's now go to ratio analysis. So pick up your pen and paper. We are going to be doing 10 ratios in this exam, 10 of them. If you want to do 11, it is fine, okay? If you want to do 12, maybe you are fine. But let me tell you something. If you start doing more than 10 or 11 or maximum 12, you're already wasting time. You don't need to do 20 ratios in this exam. So these 10 ratios I'm going to give you tonight is going to feature, or you can apply it to any financial statement analysis, even in practice, okay? The only way or the only reason why we are not going to apply it is if the examiner now decides to give us industry-specific ratios that I mentioned earlier. But again, we're going to wait for the present case scenario to see whether these general ratios will be applicable, or we need to start thinking about industry-specific ratios. Okay, so 10 ratios. And the good thing is this, I will also show you how to generate the formulas. You don't need to cram the formulas, okay? You don't need to cram the formula. I really wish I can use my board marker. Where is even the board marker? Oh, come on. Okay, I don't even know where I placed it. But let me continue. Let me continue. So just listen. Okay. So we are going to apply these 10 ratios. And after we have looked at the 10 ratios, I will now show you how to interpret financial ratios. And that will be the end of the lectures this evening. And next week, we will now start looking at questions. So this is the most critical area of the lectures. So I needed you to listen. So let's look at ratio analysis. Okay, so under ratios, we have about 5 categories of ratios. Okay, number 1 is profitability ratios. Under profitability ratios, we have about 6 or 7 of those ratios. For example, you have gross profit margin, you have net profit margin, you have return on capital employed, you have capital employed turnover, you have return on total assets, total asset turnover. Okay, so you have about 5, 6, 7 of them. Okay, but we cannot do all the 5 or 6 or 7 of them, because if you do all those 5 or all those 7, what you have done successfully is that you have successfully analyzed the profitability of the company. Meanwhile, for you to have a balanced analysis, you need to look at profitability of the company, you need to look at liquidity, you need to look at short-term solvency, long-term solvency. Okay, so you cannot look at one aspect of a business and make your conclusion. So that's why you cannot do all of that 7 alone. Okay, so you cannot do all of that 7 alone. Is that okay? So now, under profitability ratios, normally profitability measures the performance of a company. We are going to be doing 3 ratios under that. So bring out your pen. Number 1, gross profit margin. Okay, gross profit margin. So that's the first one you will be doing. Gross profit margin. Okay, now, how do I generate the formula? Are you listening? How do I generate the formula for my gross profit margin? How do I generate the formula? Somebody is saying I should take it easy. I'm actually very slow, and I'm saying it as many times as possible. Just listen to me. I'm not rushing anything, okay? So I said we're going to do 10 ratios, and I'm still under profitability ratios, okay? I'm still under profitability ratios. Somebody said I'm not slow. Okay, so what will I do? Will I be saying it? But I'm saying it as many times as possible. Okay, so just listen. I'm saying it as many times as possible. I've been talking about gross profit for the last 60 seconds. It's still the same thing I'm saying. I've not even talked about the formulas. Okay, and what I've said earlier was to say there are 7 ratios under profitability ratios. And I was giving the reasons why you cannot do all those 7. Because you have done all those 7, you are only analyzing the profitability of the company. Okay, so that's why you cannot do all the 7. Okay, all right. Yes. Okay, so, but we are going to do 3 ratios under profitability, and one of them is gross profit margin. So all you need to do is to remember gross profit margin in the exam. Once you can remember it, you can generate the formula from the name of that ratio. So you need to now remember the code. So let me give you the code. Somebody can help us write the code on the charts. So the code is this: what is on the left over what is on the right. So the code to remember your formula is what is on the left over what is on the right. So that's the code. If you can remember that, you are fine. If you get confused in the exam and you say what is on the right over what is on the left, I don't know what I can do to that, okay? But just remember to say that, to remember to say what is on the left over what is on the right. Remember, I'm your lecturer. It's going to work for all the ratios. What is on the left over what is on the right. So when I look at gross profit margin, what is on my left is gross profit over margin. So because I am looking for margin, so I need my revenue. So it will now be gross profit over revenue. Does that make sense to you? Multiplied by 100%. So that is my formula. So that's what how you can remember the formula. So from the name of the ratio, just look at the name of the ratio, then you can generate your formula from the name. So what is on the left over what is on the right. So you can decide to decode it in any manner you're going to remember. That is fine. But I'm just trying to help your mystery so that I'm not bothered about remembering. You don't need to spend the whole night. Even if I'm taking corporate reporting, in corporate reporting, you need to learn all the ratios because any of them can be tested. But for case study, 10 of them is okay. Okay. So they need to learn all the ratios. They don't need to spend the whole night learning them. Okay. Just remember those ratios. Then from the name, you can generate your formula. So if I look at net profit margin, which is our second ratio, write it down. The first one is gross profit margin, and the second one is net profit margin. Okay, the same way, what is on the left over what is on the right? Net profit over margin. So because I'm looking for margin, and that will be my revenue. So it will be net profit over revenue. Okay, net profit over revenue. Okay, I have a comment here. Left, right, left, right. That is interesting. I love that. Yeah, left, right. So what is on the left over what is on the right? Now, let me give you a joker here. It's because this is case study anyway. There are some of those ratios that it will be the vice versa. Okay. For example, if you are looking at capital employed turnover, okay, it will now be what is on the right over what is on the left. But because we are not taking that, so don't let me bother you. But I'm taking corporate reporting, obviously I'll get that area. But I can bet it this code works for all the formulas in the ratio. Okay, I'm a lecturer. Somebody wanted to argue that with me in one of those diets when I was taking it. And I said, yeah, bring on the ratios. And he was bringing it on. And I was writing the formula based on this code. The guy was shocked. He was shocked that, wow, so this is actually working. So how many ratios have I mentioned? I've mentioned 2 already. I've mentioned gross profit margin, and of course, net profit margin. The third one, remember we are under profitability ratios, okay? We are under profitability ratios. So the third one is return on capital employed. So that will be the third one, return on capital employed. Return on capital employed. So that will be the third one. How do I generate my formula under return on capital employed? How do I generate my formula? Okay, we said what is on the left over what is on the right. Return on capital employed. Look at that. Return over capital employed. That is the formula. Now, be with me here. When you hear the word return, what comes to your mind? When you hear the word return, what comes to your mind? It is profit. Returns means profit. Okay? Be with me. Just listen. Return means profit. You know, this is your requirement, so we can't joke with it. So I needed to take it slowly. Return means profit. So when you now look at your income statement, you have about 2, 3, 4, 5 returns in the income statement, maybe about 2 or 3 of them. Let me recall them. One of them is gross profit. One of them is operating profit. They also call it profit before interest and tax. Another one is, let's say, profit before tax, depending on the structure of the income statement. Then you have profit after tax. Does that make sense to you? So which of these profits is this return talking about? Remember, we are talking about return on capital employed, okay? So that return means profit. But out of these 3 profit or 4 of them, which of them relates to capital employed? So let me prove it for you. That's why I said you don't need to cram. When you're looking at capital employed, what does that mean? Capital employed means the money I used to start a business or the money I'm using to operate my business. That's the meaning of capital employed. Okay? So if you have done SFN, okay, I have a question here. Is operating profit the same thing as net profit? Yes. Sometimes it could be the same. So that's why I said it depends on the structure of the profit or loss account. So your net profit is also your operating profit. Sometimes it can also be your profit before interest and tax. But your net profit is not your profit after tax. That's what most lecturer would have taught you. They are not. And I can prove that. Okay. But we will come back to that later. So now listen to me. My capital employed. If I want to start a business, I'm going to start with my money. Nobody can start a business and entirely finance that business with debt. If you have done SFA and you have a good lecturer, the lecturer should have told you that M&M theory they are talking about financing a company entirely by debt. Why? Because interest on debt are tax deductible. But in real world, you cannot really start your business entirely with debt. Even if you are going to start with debt, obviously, there will be some elements of your own money inside that business that you are using, inside that money that you're using to start the business. So when I have my money to start a business, or I call my friend, let us start this business, and we contributed money so that we can start. That money that we contributed is called equity, okay? Or you call it share capital. Now, and in your SFA, they will tell you that if a company is entirely financed by equity, the business is exposed to business risk. Did you see that? Now, if I want to expand my business, I want to introduce more products and I need more money, but I cannot raise money by myself. I now decide to go to the maybe floor of the exchange, or I go to the bank to borrow money, or I go to friends so that they can borrow me money and it has interest. So the money I borrowed is called debt. Okay. So that debt will now come into my business. So I have equity and I have debt. Equity plus debt. In SFN, they will tell you the company is now faced with both business risk and financial risk. So that equity and debt, if I combine them together, that is the capital employed. So I now need the return on those capital employed. So be with me here. And I told you to say the return on that capital. Anytime you hear the return, it means profit. So which profit am I looking for? So that profit there must relate to the capital that are employed, which is my equity and debt. So now that profit will now be profit before interest and tax. Does that make sense? So that is return on capital employed. Do you know why it's like that? You don't pay interest until you make profits, and you don't pay tax until you make profit. So that's why it has to be profit before interest and tax. So that's how to generate the formula. Okay, that's how to generate the formula. If you are doing return on equity, that means you are looking at return on equity holders. What will it be? It will be the profit that is left after all expenses has been settled. So in that case, it will be profit after tax over equity. So that's that. So if you are doing corporate reporting, obviously that clue is going to help you. So those are the first three ratios we are computing. Number one is gross profit margin. Number two, net profit margin. And number three is return on capital employed. You should be clapping for me the way I'm analyzing all these things. You didn't pay for this ones anyway. Don't mind me, I'm just joking. Okay. So under that, those three ratios, we have seen profitability ratios. Okay. So we have three ratios already. We have three ratios already. And from the name of those ratios, I can generate for my formula. So it will be okay, somebody is saying PBIT over what? Over capital employed. Yeah, I just said that. You know, we are looking at return on capital employed. So it will be PBIT over capital employed. I was just trying to prove to you why it has to be PBIT. Okay. So that's why I was explaining all of that. Okay. Thank you for the people that are clapping for me. Thank you. So I hope you're understanding all of this. I just wanted it to be so comfortable and you are already familiar with the 10 ratios you're going to do. So you already know those 10 ratios from now. You know how to interpret them. All we are waiting for is to get the percent. The moment we see the percent, we hit the ground running. Okay. Okay, so that's what we are doing. That's what we are doing. Thank you for the people clapping. Okay, thank you. Now, so we have done three ratios. Can I take that again? Somebody can also help us to put them on the chart so that I can help some of us. Okay. So the first one is gross profit margin, and I told you how to generate the formula. So the second one is net profit margin, which is net profit over revenue multiplied by 100%. And the third one is return on capital employed, which is PBIT over capital employed multiplied by 100%. Remember, you have some other formula like capital employed turnover, return on equity, return on total asset, and all. So you may not bother yourself about all of that so that you're not wasting time in the exam hall. Is that okay? So somebody say capital employed means total asset. No, sometimes it may not. Okay, that's why I say capital employed is your equity plus debt. So your equity means your share capital, your share premium, your retained earnings, your revaluation reserves, and other components of equity. And your debt means long-term debt. So it can be your total asset. Except maybe in some structure of the balance sheet, your total assets sometimes might equal your capital employed, but it's very rare. Is that okay? So your capital employed in this case is your equity plus long-term debt. So please take note. Okay, please take note. So when we see questions, you are going to see all of that. Okay. And another way to get your capital employed is to look at total asset minus current liability. So that's it. It's going to give you the same answer. Okay. So if you say, can capital employed be net asset? The answer is no. Okay. So net assets. It also depends on the structure. Okay. But naturally, capital employed cannot be total assets. Take note of that. But in some cases, capital employed can be net assets. Okay, but don't confuse yourself about net assets. Okay, so but then your net asset is your what's it called? Your total asset minus current liability, which will also give you the figure, the same figure, when you look at your equity plus long-term debt. So sometimes capital employed can be your net asset, okay? But it cannot be your total asset, okay? All right, I think that's clear. Now, so let's go to the fourth ratio. That will now be under liquidity ratio, okay? So we are under liquidity ratio. So when you want to assess the performance of a company, you will look at it from liquidity point of view. So we have looked at it from profitability point of view. That is where you are doing gross profit, net profit, and return on capital employed. So we also look at it from liquidity point of view. And under that, you have two ratios. One is current ratio, and the other one is acid test or quick ratio. Okay, so the current ratio, you know that already, current asset over current liability. And the standard is 2:1, ratio 2:1, okay? Then the quick ratio or acid test ratio is current asset minus inventory over current liability, okay? Over current liability. And that is 1:1. So that's the standard, okay? So it helps you to also assess the current liquidity of the company, okay? So please take note of that, okay? So we have 5 ratios already. I think somebody's already helping us to write on the chat room. You can help us to update that. Current ratio, under liquidity ratio, current assets over current liability. Then you have quick ratio or acid test ratio, which is current asset minus inventory over current liability. So we have 5 ratios already. Then we are left with 5. Okay, we are left with 5. Okay, I like the way someone is helping us to analyze that. Thank you so very much. Thank you so very much. So let's go to the short-term solvency ratio. Short-term solvency. Okay, I have found my marker board, but I cannot connect it now. It's going to distort the lectures. Okay, so this is my marker. I just find it. I couldn't see it when I wanted to start the class. So, but I think I'm trying to also make it lively. Okay. Somebody is saying, can you help us to explain the meaning of 2:1? It's very simple. What that means is your current asset should be twice your current liability. That's the meaning. Okay. So that means when you compute your current ratio, you should be getting something like 1.12 to 1. Okay. Or you are getting 2.1 to 1. Is that okay? So what that means is your current asset should be double of your liability. The moment you are getting 0 point something, that means you don't have sufficient assets to settle your current liability. That's the meaning. It's already falling below 1. If it falls below 2, you are still fine. Okay? You are still okay. But the moment you are getting 0.9 or 0.8 to 1. That's a problem. That means the company is not liquid. So the company can be profitable, but they are not liquid. So a company can be making profits, but there's no cash. That's the meaning. So the same thing with 1 to 1. That means your current asset minus your inventory should equal your current liability. It should balance. And the reason why you are removing your inventory is because you cannot control your inventory to be converted into cash. Okay, so you are looking at those other items that you can easily convert into cash. So if, for example, you needed to settle your liability before the due date, can I really recall all of this? That's why you just look at your cash, your receivables, your short-term deposits, fixed deposits, and all of that. So that's why you are removing inventory, because you can't force people to come and buy your inventory. But your receivable, you can call on your debtors to pay your money. Okay, so at that point in time, it should be 1 to 1. So you should get something close to 1, or even 1 point something. When you get 0 point something, that means you are not liquid. So that's interpretation. Okay. Sorry, that's interpretation. That's normal interpretation. Okay. Again, it now depends on the nature of the industry. There are some industry that they will be highly liquid. It doesn't mean they are performing. Deal with me here. That is why it is case study. Okay. If you go to an airline business, if you compute their liquidity ratio, in fact, you can get 3 point something. You know why? Even the flight of 1 year's time, people are booking it today. So they have huge cash flows. And cash flow is not profitability. Sorry, profitability talks about the ability of a company to make profit year in, year out. Profit is just for 1 year. Profitability is the ability to repeat that profit year in, year out. Okay, so a company can be highly liquid, but they are making losses, and a company can be making losses and they are highly liquid. A company can be profitable and they don't have cash. They are not liquid. Okay, so all these ones are the meaning of those ratios by default. So we are not going to start seeing scenarios on how to apply all of this into, real case study. So that's why you cannot cram it. You can't cram financial analysis, but it is good that you know the basic meaning. Then before we now start going to the advanced on how to apply that. If you go to FMCG, they are highly liquid. Money is coming. In fact, production is running to meet up with demand. Demand are there already. Demands are higher than production level. Okay, so they are running. So if you check their bank statements, you see that they are highly liquid. But again, they have huge contract liability. Their liability will be high. So sometimes they are, trying to catch up with fulfilling those customers' orders. So that means you are going to also check the nature of the industry for you to be able to come up with your conclusion as to whether this company is actually illiquid or they are highly liquid. Okay, so we have 5 ratios already. So let's go to short-term solvency. So we have seen profitability ratios. We have also seen liquidity ratios. So let's go to short-term solvency. In some textbooks, they normally merge liquidity and short-term solvency, but I don't like that because they are 2 different things entirely. So I will separate it. So short-term solvency, there are 3 of them that you're going to do, which is also the working capital management. So number 1 is inventory days. Okay, so that will be number 6 ratio. Inventory days. And what's the formula? Inventory over days. You're on your own. So it will be inventory over cost of sales multiplied by 365 days. Okay. Inventory over cost of sales. Sold on credit. Okay. When I sold goods on credit, then I have receivables. So revenue. So the formula will be receivables over revenue. Okay. Multiplied by 365 days. And the last one there is payable days. I bought on credit, okay? So ideally, it should be payable over credit purchases, but you won't see purchases because they would have done back and forth. So you are going to see you are going to use cost of sales, okay? So payables will be payables over cost of sales multiplied by 365 days. Receivable is receivables over it's also supposed to be credit sales, but again, you are going to use revenue, okay? So to be receivables over revenue multiplied by 365 days. So let me take that again. Inventory days, it will be inventory over cost of sales, sorry, multiplied by 365 days, okay? And of course, receivable days will be receivable over revenue multiplied by 365 days, and your payable will be payables, that's payable day, will be payables over cost of sales multiplied by 365 days. But don't forget there are trade payables, okay? Trade payables, and of course, trade receivables. So if the examiner did not give you note to the account, just use the entire receivables in the account or the entire payables in the account. But if it gives you note to the account, so it's going to break down that trade payables, okay? Oh, sorry, it's going to break down the payables. So under that, you see trade payables and other payables. So you're going to use trade payables, okay? But if it doesn't give you note to the account, just go ahead and use the entire figure. Okay, so that's that. So that's the formula. How do you interpret this? Be with me here. Be with me. Cash operating cycle is also called working capital management, which we are also seeing under short-term solvency ratio. Okay, normally, short-term solvency ratio measures the ability of a company to meet its short-term financial obligation. Okay, the ability of a company to meet its short-term financial obligation. Okay, I have a comment here. The calculation of these ratios will be under appendix. Yes, the answer is yes. So you do it under appendix. It's like an attachment to your report. But remember, if you do all of these 10 ratios, you will score 1 mark. So don't bother, that's why you cannot do 20 ratios. But unfortunately, you need these figures to go and analyze in your main report. The maximum amount of scores you can have on that appendix is 4 marks. So why am I bothering myself? You remember you would have done trend analysis. That's 1 mark. If you do 10 ratios, another 1 mark. If you do some other calculation, then another 1 mark. Okay. So maximum you have about 4 marks around there. Okay. So how do I interpret inventory? Inventory days, receivable days, and payable days. If my inventory is increasing, okay, if my inventory is increasing, that means I am not selling. Maybe I'm not selling, or I am producing more. My production is faster, more than my sales. It doesn't mean my revenue will not increase. My revenue can be increasing and my inventory is also increasing. Is that okay? So it just means that probably I'm not selling at a faster rate as much as I am producing. Okay, so that could be responsible for increase in my inventory. In my inventory days, that means it's taking me more days for me to sell after I might have produced. And is there any issue in that? The answer is yes. You know, if you have your inventory in your warehouse, that means you need to maintain the warehouse in terms of lightning, in terms of insurance. You know, if it's some perishable goods, you need to keep them in good condition and all of that. Okay, so that's the issue with inventory. Okay, so normally when I'm producing, some of my materials would have been purchased on credit that would have triggered payables. Okay, so I have payables. So if my payable days is increasing, what does that mean? It simply means I am not paying my suppliers. Normally, when I buy on credit, I can have an agreement with them to say I will pay in 30 days, okay, or in 40 days, depending on the agreement that I have with them, okay? So if my payables is not increasing, that means I am not paying them on time, okay? For example, in year 1, I have 55 days. In year 2, I have 70 days. In year 3, I have 80 days. That means it takes 80 days for me to pay my suppliers, go and check. If payable days is increasing, receivable days will also increase. Okay. So what that means is this. There is a relationship between receivable days and payable days. Okay. I sold on credit. When I produce inventory, I can sell on credit. Even though I may not be selling at a faster rate, but I can sell on credit, that will make my revenue to be increasing. Okay. But because I sold on credit, I already have receivables. So if my receivable is high, because I am not collecting money, most likely my payables will be high. Does that make sense to you? Okay, if my receivables is declining, normally my payables should be declining, because as I am receiving those money, I should be using it to settle the people I bought raw material from on credit that I used to produce my inventory. So this is a twist to it. If my receivables are declining, and the company's payable are increasing. What does that mean? That means as they are receiving that receivables, they are using it to do something else. Go and check non-current assets. Most likely it will be increasing. So they are not using those receivables to settle their payments. Again, if my receivables is increasing, but my payable days are declining, where is the company getting money to pay the suppliers? Go and check. Maybe they have overdrafts, or they have increase in debts, long-term debts. So most likely, they're already using those long-term debts to come and settle those payments, rather than them using short-term source of finance to finance short-term source of finance. Did you see that? So that's mismatch in financial management. Okay, so I'm just trying to give you some insight into how to hover around your inventory days, your receivable days, and of course, your payable days. So normally, they should have they are directly related. Okay, so if one is increasing, the other one should also be increasing. But if one is increasing and the other one is declining, you have to query it. What's going on? So I'm just giving you some insights. Somebody said, I don't understand the interpretation. Oh, okay. So this is what it means. From the word receivable, what does that mean? You sold on credit. Does that make sense? Expecting that your customer will pay you. So when they pay you, you use that money to go and settle your payables. You're also owing people because you bought raw material from them to produce your inventory. That's a cycle. That's why they call it cash operating cycle or working capital management. So what will make my receivables to be increasing? It will be increasing because my customers are not paying. And if they are not paying me, my payables will also increase because I will not have money to pay them. So that's why I said they are directly related. So if receivables is increasing, payable days should also be increasing. If receivable days are declining, that means people are paying. My payable days should also be declining. That's what I said. But I now said, if my receivable days are increasing and my payable days are declining, then I have to query it. Because when my receivables are increasing, that means I'm not getting money from my credit customers. So where did the company see money to settle payables? So that's why I said, check the financial statement. Most likely they are using debt, maybe long-term debt, to settle those payables, or they have gone for overdrafts. That's what I just said. Because it's working capital management because it's a short-term sources of finance. So that's why sometimes they will say, for you to do case study, you need a knowledge of source of finance. And you do that in your SFM, okay? So that's the entire cycle around that. So I'm just trying to give you some insight. But when you get to scenarios, you will understand better, okay? Somebody say, can we use average receivable and payables instead? No, you don't need to use average. You can only use average if you're given opening figure and closing figure. But in this case, they won't give you all of that. Okay. Explain the interpretation of inventory days. I said if it is increasing, that means you are not selling as fast as you are producing. And if it is declining, that means you are selling as fast as you are producing. Okay. So just like you are producing, you are not selling. It will make your inventory days to be increasing. Okay. Are there any standard benchmark for short-term solvency? No, there is no standard, but in real life scenario, your receivables should be around 30 days, depending on the agreement you have with the credit customer. So it varies from industry to industry. So for example, in some industry, they can say you must pay me in the next 10 days. Okay. Then in some industry, it could be 30 days. The same thing with payments. Some company can say, if I'm buying from my supplier, I can have an agreement, supplier A, I'll pay you in 30 days, supplier B, I'll pay you in 40 days. So it varies from industry to industry and from company to company. So there's no standard actually. Okay. But again, for your exams, the moment is higher. So you're going to use work experience to know whether it's high. For example, if you are doing receivables and you're having something like 8 days, 20 days is still reasonable, because in practice, we have some credit customer that will pay in 20 days. Okay. But the moment you're having 40 days, 50 days, 60 days, in fact, I've seen some you have 100 days, that is so wide. Okay. So you have to start querying that. Okay. Okay, so we have how many now? I think we have 8. We have 2 to go. Okay, so let's look at long-term solvency. Okay, I have a question here. What you just said, receivables, can we fit it into the notes? What's that? Can you write that out? Because I've said so many things. Okay, so let's look at long-term solvency. We have spent 7 minutes over the normal time, but let me complete this. Okay. So long-term solvency, we have 2 ratios there. So the first one is gearing ratio. So that talks about debt over equity plus debt. Okay. So it talks about debt over equity plus debt. Debt, that's long-term debt over equity plus debt. So gearing ratio is also known as leverage ratio. Okay. So the formula is debt over equity plus debt. So that your debt is long-term debt multiplied by 100%. Is that okay? Then number 2 or number 10, you have debt to equity ratio. So the first one is gearing ratio, also known as leverage ratio, which is debt over equity plus debt multiplied by 100%. They now have debt to equity ratio, or you can even do debt to asset ratio. But let's do debt to equity. So debt to equity is just debt over equity multiplied by 100%. Then if you want to also do debt to asset. So when you look at, if you are doing debt to asset, technically that's a common size, because you're looking at debt to total assets. Okay. So those are the 10 ratios you should start learning. Okay. So gearing ratio is debt over equity plus debt multiplied by 100%. And debt to equity ratio is debt over equity multiplied by 100%. So successfully, we have 10 ratios. Okay. I think I have a question here. The financial statement is usually given comparative years. Can the data for the preceding year qualify for opening balance? Okay. Yeah, of course. My receivable days, oh, sorry, my receivable balance as at the end of year 1 is my opening balance in year 2, obviously. But you don't need to bother yourself with this, okay? All you need to do is just compute the days. Is it increasing or declining? That's what you are interpreting. Is that okay? But you are correct with that analogy. Okay. How does the issue of balancing figures come into play into payables? Because cost of sales is on an accrual basis. You don't need to bother yourself. These are accounting issues. You are only interpreting performance. Okay? So don't bother yourself with all of these details. All you are doing is just use the word, the cost of sales. No. So don't forget that most of these figures are doctored. Okay? So you don't need to bother yourself around balancing figures and all of that, or probably cost of sales and accrual basis. Some of them are also cash basis, don't forget, because I can pay and I'm recognizing cost of sales. So it's not entirely accrual basis. So don't bother yourself about all of that, okay? All right. So help us to update our ratio. So we have 10 already. We have 10 already. Okay. Is interest cover non-needed? If you want to do it, you can do it. You know, I mentioned earlier to say don't do more than 11 or 12 ratios. Okay. So interest cover can be part of your long-term solvency ratio. That makes it 11. If you want to do it, it is fine. I don't have issue with that. Remember, I have seen students, you know, they were falling for ICANN. Okay. And why are they falling? They were not guided on the number of ratios they should do. Some are doing up to 15, 20 ratios and it's wasting time. Okay, let's look at it. If you do 15 ratios, are you telling me you interpret everything? Where's the time? You can't interpret everything. Never. How? If I want to interpret these 10 ratios, if I'm not writing exam under normal condition, not exam, and I want to do this for my company, because I normally do it under my financial risk assessment that I send to the board. If I want to do this, it will take me not less than a week to do it, 8 to 5 every day, analyzing these 10 ratios. You cannot imagine you are doing this for 4 hours. I mean, I'll do it for a 1 week stretch. I'm on that report. I'm analyzing audited accounts for the last 3 years or 5 years. And I want to put up all of this because you have to look at it properly, the figures, the analysis and everything, and come up with great interpretation, so that they can make decision. Because the whole essence of this is to make informed decision. Okay, so you want to do interest cover, it is okay. You can even do debt to assets. I mentioned that. But what I'm just preaching is to say, please don't do more than 10 or maximum 12. So we're adding interest cover and debt to asset ratio is fine. Okay, even though you can do up to 20, but obviously you can't analyze more than 10. So why will I do 20 when I know that whether I do 10 or I do 20, I'll still score 1 mark? So why am I wasting time? So the time you are still punching your calculator, doing up to 20 ratios, you're already writing your report. It is your report they are going to mark. If it is corporate reporting, that is unlimited, okay? And this is case study. It is not corporate reporting. Thank you for the updates. Wow. Somebody even helped us to write the formulas out. I love this. Thank you for being our brother's keeper. I also have something here. I mean more about interpret and put into reports. Of course, we will do that. We will do that. Don't worry. I won't do that this night. Time is gone already. So that's where I will start from in the next class. Although I have the plan to do it this evening, but because I have to, take it slowly so that you can understand. So how do you interpret financial ratios and to put it in the report? So don't worry, I'll give you formula on that, okay? So that's where we start from next week. What about investors ratio? You don't need that. That is where you talk about EPS, earnings per share, price earnings ratio, dividend yield, dividend cover. You don't need all of that in case study. Okay, you will have the information. You won't see the information. Okay, for example, dividend cover, dividend price earnings ratio. You won't see all those information in the case scenario. Okay, so you don't need to do all of that. Thank you. All right. I love this analysis. So somebody already did that for us. Thank you for that. All the 10 ratios. So start familiarizing yourself with these 10 ratios. You can also go and know their meaning by default. But I also mentioned earlier to say, when you now see real life financial analysis, it can change because of the nature of the industry and some other factors. I do hope you are blessed this night. Thank you for staying tuned. I think we spent over 15 minutes of the normal time, but it's worth it because I just needed you to understand. So next week, by God's grace, I will take you through how to analyze these ratios and to put it in the report, like somebody has said. Somebody said I didn't explain the last. How will I explain? I already said gearing ratio, which is leverage. Debt, what's it called? Debt over equity plus debt. We are just looking at whether the company is highly geared or not. Okay. So if you get more than 50%, then say the company is highly geared. And normally, your lecturer would have told you that the company is risking liquidation. That means the amount of debt is higher than the equity in the business. And when your debt is higher, then if care is not taken, the company might be risking liquidation. But for case study, I beg to disagree. Again, you are going to look at the nature of the business, because some businesses, by nature, their debt is always higher. In fact, it can be up to 90% when you compare with the equity. But it doesn't mean they want to die. It doesn't mean they are risking liquidation. It is just the nature of the industry. I see that in the aviation industry. You see that in maybe construction or all this heavy duty equipment industry. Okay, so that's the meaning of gearing or leverage ratio. Then the same thing with debt and equity. You are looking at the proportion of your debt to your equity. Okay, you are looking at the proportion of your debt to your equity. That's what you are doing. So what's the, I said it earlier when I explained common side, what's the proportion of my debt alone with my equity? But the gearing ratio is looking at how risky a business is. So that's why you're seeing debt over equity. You are not adding that debt back. That if I even had the debt back, what will still be that position? So that I can see whether I have too much debt in my capital structure. Okay. So that's just interpretation around that. Okay. But again, when we get to questions, you will see that properly. Okay. Okay, how do you factor in changes in absolute relative times while calculating? No. When you are calculating, obviously, you start from the absolute terms now, which is the figure. So I need the figure to calculate, but I will transform that figure into relative terms, which is your percentage. So that's why if you notice, most of those calculations or most of those formulas, you are multiplying it by 100%, except for your short-term solvency and your liquidity ratios. Short-term solvency, you're multiplying by 365 days. So your answer will be in days, okay? Then for your current ratio, it will be 1 point something point ratio 1, okay? Other ones are in percentages. So, but obviously, you are going to use those figures to get those. What I said earlier was, when you are doing your interpretation, your report, don't quote the absolute figure, okay? That's what I said. Don't quote the absolute figure. Quote the percentages or the days, okay? Or the ratios, the final answer, if you are doing current ratio that you have gotten, okay? All right, thank you very much. So if you have further questions, you can chat me up. You can put a call through to me. Okay, somebody is also saying you can help us put those formulas into the group chat. All right, that's fine. But what was done here, I think is correct. Receivable, okay, it's only receivable that is not correct. So receivable will be receivable and revenue. I think she has corrected that as well. Okay, receivable and revenue. Okay, that's fine. What's the formula for payable? Payable are cost of sales multiplied by 365 days. So somebody can just help us and put it on the group chat. That's on WhatsApp. So it will also help. I'll go through it. If it's not correct, I'll correct it. Okay. All right. Thank you for your time. I'll see you next week. Enjoy your Easter. Take care. Bye.